Hello everyone, welcome to our discussion of ratio analysis. This is chapter 7, the last chapter in our Accounting 161 class. This really ties back to the idea that we were presented clear back in Accounting 150, where we talked a little bit about ratio analysis as a way of understanding the financial statements and able to some tools to help us understand what we're reading, what story is being told by the financial statements. So we've come circle around and come back to this idea where we can kind of add a little more to our understanding and wrap this class up for this term. So first thing we want to talk about is what we call horizontal analysis. And horizontal analysis, because we generally put financial statements side by side or for different years, it's referred to as horizontal analysis because it moves left to right. So we're comparing one year to the next. We can put the income statement for 2020 next to the income statement for 2021. Next to the income statement for 2022. We can do the same thing with the balance sheet. We can say same thing with the cash flow statement. Okay. So what we might do with that, once we have them side by side, is we find the difference between 2 years. So we might compare revenue for 2020 to revenue to 2021. See if it went up. See if it went down. See the difference, how much it went up or down. Okay. And then calculate the percentage that it changed. Okay, so we can take 2021 and subtract 2020. So the revenues for 2021, subtract the revenues for 2020. Take that difference and divide it by the oldest year. You always divide by the oldest year and then move it over a couple spots as far as making it a percentage and see what percentage it was that it changed. You can do the same thing with expenses. So if you've got cost of goods sold for 1 year and cost of goods sold for the other year, we can take the difference and divide it by the oldest year to get the percentage change. Okay, you can have it go up, you can have it go down. Okay. You can do the same thing with the balance sheet. Compare cash 1 year to the next, or accounts receivable. More often than not, income statement is what we do horizontal analysis on, and cash flow. Okay? So why do we do this? We want to see trends. We want to see comparison. This is us comparing 1 year to the next to see about improvements. Okay, we're focused on those things that change a lot. We're focused on the numbers that are large. We're probably going to ignore things that are like small items like gains or losses if those aren't significant or didn't happen 1 year and did the next, things like that, because we're looking for what things are repeating, those things that are indicate the actual health of the company. Okay, so we're going to note when we write about it or talk about it or try to understand it, we're going to note the direction. Like, for instance, sales increased 4%. Is that good? Is it bad? Why? Okay, from 2020 to 2021. If everybody else did 4%, then that's okay. Okay, but if everybody else went down and we were still able to increase it by 4%, that's really good. If everybody else went up 10% and we only went up 4%, then that's not so good. Okay, so that's the kinds of things. So you're going to use that idea and then compare it to other companies. Okay, same thing with, say, for instance, research and development, which is a good indication of how much the company is spending on new ideas and such like that. If they are increasing that, okay, that may show that increased commitment to that. If it decreased it, that may be a bad sign, or maybe that they've just been more efficient. So could be good, could be bad, and then think about why that might be the case. So that's what horizontal analysis is, comparing year to year. Now the other kind of framework that we sometimes use is called vertical or common size financial statements, okay, or vertical analysis. So to do this, we take that income statement, we just take one income statement, all right, and we calculate everything on that income statement as a percentage of sales. So sales or revenues is the first item on the the income statement almost every time. So we take the cost of goods sold, for instance, and divide by the sales amount. We take interest expense, divide by the sales amount. Okay, we take any of the items on the income statement, divide by sales, so we can see what percentage of our sales are spent on that particular expense. Okay, that should stay pretty consistent, meaning year to year you should spend about the same percentage of cost of goods sold. If that changes from one year to the next, that's something to investigate, that's something to wonder about, that's something to look into. All right. It also makes it easy to compare large and small companies because a healthy company is going to have a similar percentage of sales for each expense. So comparing $1 million expense to $1 billion expense doesn't help us much when we're talking about those dollars. But if we can say, well, this company spent 5% of their sales on research and development, then we can compare that. We don't have to worry about whether it was a small company that spent a little bit or a large company that spent a much bigger amount. Because what we're really worried about is what percentage of the sales it is. For the balance sheet to do vertical analysis, you compare everything, you divide everything by total assets. So cash divided by total assets, property, plant, and equipment divided by total assets. Okay, everything is, the reference point is total assets, including the liabilities. Okay, accounts payable divided by total assets. So you know how much of your total assets you owe in accounts payable. Okay, those are the kinds of comparisons we use. Then, of course, we can, once we've created that percentage or same size income statement, we can compare it to the year before, okay, to the year 2 years before ago. We can compare it to other companies, okay, to see what that looks like as a reference point, to see if we feel like they're doing well, if they're improving. Okay, we want them to become more efficient, right? We want them to spend less of their sales on the various expenses as they become more efficient over time. Okay, that would be the goal. So that brings us to the profitability ratios. All right, all of these are percentages except for earnings per share. Okay, gross margin percent, gross profit, which is sales minus cost of goods sold, and then divide by sales. Profit margin, you're subtracting your other expenses. We're not going to include tax expense typically in there. So operating income divided by sales gives you our profit margin percent. Remember, we're moving it over 2 decimals to get the percent. Return on assets, investment equals operating income. Notice these are the same, right? Operating income. Divide now, instead of by sales, by average total assets. And return on equity, operating income divided by average total stockholders' equity. Okay, that would be the beginning. When we're talking about an average, talking about the beginning of the year plus the end of the year, divide by 2. So this is total assets off your balance sheet. This is total stockholders' equity off the balance sheet. So these first two, you're using just income statement numbers. Okay, these two, you're using comparing income statement measures to balance sheet measures. These are all ones that you want to increase as much as possible. Obviously, if you don't get return on equity of 100% very often, but you're wanting it to be higher, right? You want to improve and get higher return on these various measures. Earnings per share, net income minus preferred dividends. If there's no preferred stock, then there's no preferred dividends. divided by weighted average shares outstanding. We're not going to go into detail about how that's calculated. We'll just have that given to us. So that's just a dollar amount. So it should be should have a dollar sign, and it should be carried out to the nearest penny. Earnings per share is how much the company made per share of stock. So that would tell you if you own one share of stock, how much did the company make profit-wise for you, all right, for that one share. Now, liquidity, we have talked about in an earlier class when we presented these. Okay, so this is a little bit of review. Current ratio is all the current assets divided by current liabilities. The quick ratio are the quick assets divided by current liabilities. Again, notice current liabilities is the same either way. And quick assets is defined as anything more liquid than inventory. We list on the balance sheet assets in order of liquidity. So if it's listed above inventory, it's more liquid. Literally on the balance sheet, if it's above inventory, it's more liquid, and that should be included in quick assets. Okay, don't go with the formula that sometimes will happen when you look things up on Google for that. All right, because it will be incorrect often. Okay, so use the definition of quick assets, which is anything more liquid than inventory. This is a measure. Both of these are measures, and current ratio has to be higher than the quick ratio. So if you get a quick ratio that's higher, you've made a math error somewhere way along the way. These are measures of how much assets you have compared to how many liabilities you have to see if you have enough to cover your liabilities. The higher your liquidity, the easier it is for you to meet your obligations. It does not mean that the higher is necessarily always better. If you have too much liquidity, that means you're not using your assets well enough to generate returns. So we don't want to have too much of our assets sitting around in cash, accounts receivable, that sort of thing, because that doesn't earn us much money. We want to convert them into more productive assets. Okay, accounts receivable turnover is either the credit or total sales. Typically, we're going to have to use total sales because credit sales are not broken out. But we divide that by average accounts receivable. Again, average beginning and ending divide by 2. Cost of goods sold for inventory turnover divided by average inventory. So accounts receivable, how many times per year are we able to collect our accounts receivable? The more times, the more likely we are to collect the money. So we want to push that, but if we push our customers too hard, okay, we can drive them away. So we may have situations where we don't want to have too high of accounts receivable turnover. That means we're pushing our customers too much. And inventory turnover, again, how many times per year can we sell our inventory? How many times in a year that we're able to sell all the way through? Again, we want it to be pushed to make it higher, but it can be too high, which means we have too little inventory. Our average inventory is too low, and therefore we have a lot of stockouts and customers that are upset because we don't have things on the shelves that we need for them. All right. All of these talk about how easy it is to pay our bills because our accounts receivable turn into cash, right? We collect the money from our customers so that we can pay our bills. We sell the inventory, collect from customers so that we can make it turn into cash and pay the bills. Okay? And so it's all about how our ability to meet our obligations easily and with some extra so that we can invest in things that come along or that make bad or good opportunities that come along that we may need extra money for. Now, solvency is about all of our liabilities. So liquidity is about current liabilities, those that are going to come due in the next year. Solvency is looking at, do we have the ability to pay our bills in the long term? All right, so now we're taking all the liabilities and dividing it by all the assets, total liabilities. Sometimes this is a percentage, sometimes it's not. It doesn't, however you prefer. Okay, debt to total liabilities divided by total assets. You can convert it to a percentage. Total liabilities divided by total stockholders' equity also could be converted to a percentage or just left as a ratio. This is comparing liabilities to our equity, right? So this is the total we owe to others. This is how much the stockholders own. So if you have a lot of debt, a high percentage of debt to assets, a high number of debt to equity, that's more risk. It's also can be bring about more return, okay, because we're using other people's money, but it can have a higher risk, more risk of bankruptcy, more risk of a problem if we are, that's why it's called solvency. Are we solvent means, can we pay our bills long term? A more complicated measure is the times interest earned, where we take the net income plus taxes plus the interest expense off the income statement, and then we divide that by the interest expense. Basically, figuring out how much money we have earned as a company compared to how much interest we have to pay, to see if we can pay it more than, we have more money than we need to pay in interest. You certainly wouldn't want to be in a situation where your debt payments were equal to all of your income, right? That's not a very positive situation. You'd want to have 2 or 3 or 4 times as much income as you owe in interest and debt payments. Now, this final slide is about what's referred to as the balanced scorecard. Okay? Many companies have found that if they're going to be financially successful, they can't just measure the finance part of it. That there are steps or other aspects of the business that need to be in place, need to be improved in order to get the finances to improve. All right? So we measure more than just finances. We give rewards, we have goals, we have measures to measure the success in areas outside of the finance, to keep our company good and balanced, so that we're looking at all aspects of our business. So in this concept or this model of the balanced scorecard, there is still a traditional financial, considering accounting. We talked about it in chapter 5, return on investment. We talked about economic value added, all of those measures back in chapter 5. That would be part of, but it's only a section of. To get to that point, we need to measure and improve our internal business processes. How good are we at getting our job done with few mistakes? Whether that's defects in our product or mistakes in our services. How do we measure that? And how can what's our goal to improve that percentage so that we can get a 98, 99% accuracy rate or something of that nature? Whatever the measure is of how good we are at doing our business. And if that's what we want, then what are we doing to help our employees and our processes get better? What are we doing for learning? Are we training them? Are we just saying, okay, here's our goal, and saying, oh, we hope you meet it? Or are we giving them ways to actually improve, to get better in our growth and our learning? And the last one is, how does our customers see us? What do they perceive from us? Of course, if we're doing we're very efficient, if we're doing 30 things with a few defects, they're going to see us as high quality. but do they see us as on time? Do they see us as providing value? Do they see us as actually explaining how to utilize our product in a way that is beneficial to them? Those are all part of how the customer sees us. And how do we measure that? Okay, and what's our goal with regard to that? Do we want repeat customers? Do we want loyal? How are we going to measure loyalty? Do they come back? Do we have to keep finding new customers because they don't perceive that we're doing a good job? Or how do we explain better what our job is, okay, and how we can help them? Those are all parts of this balanced scorecard. And just like you would have a measure for the ratios, you would have measures and goals, and you would look at how you're reaching those goals each month, maybe each quarter, at least once a year, looking at how we did compared to what our goal is.